On tonight's programme, you'll hear the ECB and the Bank of England chief saying that the Ukraine war has turbocharged prices, both at the wholesale level, the consumer level, and now the concern, of course, is about wage inflation. The Bank of England governor tells us that the UK faces second-round effects, so-called consumer-driven inflation. Christine Lagarde of the ECB says the uncertainty over the war in Ukraine makes the tightening policy that they were hoping to do much harder, whether it's July, whether it's September, whether it's later this year. In fact, President Lagarde of the ECB told me the war has derailed the COVID recovery and the crisis exists wherever you look.
I would say crisis over crisis, because we had crisis after crisis. It's crisis over crisis. It's like a mille-feuille.
It's overlapping crises. So how difficult is it now for the ECB to manage this with the war, with inflation, with, of course, low growth?
It makes our job a bit more complicated because of the trade-off that we have between taming inflation and making sure that we deliver on our mandate of price stability, while at the same time being attentive to not put any kind of brake on growth, which is slowing down as a result of the circumstances. We were on a path to recovery, it was going nicely, and the war arrived on February 24th. And from there on, growth has been weakened and inflation has been strengthened.
Do you expect the war to change how you and the Governing Council will view monetary policy?
We have to be attentive to the impact of the war on the economy, and in particular the impact of the war on inflation. For the moment, there is an upside risk to inflation and a downside risk to growth, which means that inflation will be propped up by commodity prices, by energy prices, added to which consumers are going to see some of their disposable income eaten up by the price of energy. So we have to pay attention to all that, but we are riveted by the single compass that we have to use, which is price stability defined as 2% inflation medium term. That's what we have to look at.
If that's your compass, Madam President, then I think I know the answer to the next question. You're still looking at tightening the policy rate before the end of the year.
We're not looking at tightening. We're looking at normalizing monetary policy.
That's the same thing, different.
No, it's not. No, it's not at all.
Raising rates.
No, because if you look at real rates, even if we were to hike interest rates, which we might very well do, okay, we would not be tightening because of the inflation where it is. It would still be very accommodative. If you want to take out a loan, if you want to borrow, you're still going to benefit from some incredibly attractive and low rates in spite of what I just said. So we are normalizing monetary policy. We are gradually removing quantitative easing. We stopped the emergency program related to the pandemic. We are looking at putting an end to the net asset purchases during the course of the third quarter, somewhere in between the 1st of July and the 30th of September. High probability that it will be early rather than late in the quarter. And then we will be looking sequentially at rates and what we do with rates.
Andrew Bailey at the Bank of England has been very blunt in basically warning people in Britain that living standards are likely to fall, or at least the hit to personal incomes, both from higher interest rates and from higher inflation. And in fact, the numbers suggest that it could be the worst fall in terms of living standards for decades. Would you say the same across the Eurozone?
I think what fiscal authorities have decided to do is precisely intended to target those people who are at risk of losing income as a result of energy prices, commodity prices, and inflation that is generated by this supply shock. If you take the 5 largest euro area countries, they've already committed an extra 0.4% of fiscal support in order to help those that are most exposed and most vulnerable. So I think that the concern that is legitimate about losing income is addressed by the fiscal measures, which is the right tool to use.
Right, but you on the monetary side, you have to do that which is necessary. I mean, Bailey said it, Powell has said it, Kristalina Georgieva said it today, that inflation has to be the target.
Price stability has to be the target. That's what we have to deliver, because that's the only way to have an economy that can work in confidence, with certainty. You know, you look at the US, it's an economy where demand is heating up, where there is no slack out there, where jobs are plentiful, and where there is hardly any unemployment. The situation in the euro area is not quite the same. We are not facing an inflation that is demand-driven, but that is supply-shocked. Okay, we are not facing a job market where you have 3.4% unemployment. We have, you know, roughly 7% unemployment. There is still slack out there.